This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The next section is discussing payments on account for capital gains tax when you dispose of a residential property. These rules were brought in some time ago, and it's to tax basically second homes. So normally you would pay your tax for capital gains tax on the 31st of January following the end of the tax year. So for 23-24 that is January 2025. However, these payments on account, this is the first time they've ever introduced this. When you sell a residential property, you don't wait till the end of the tax year to do the calculation and work out the tax. You have to do it straight away. And you have to pay within 60 days a payment on account that you anticipate. Now, if that's early on in the tax year, then you could end up paying more because you don't know what's going to happen in the rest of the tax year. It is what it is, and that's just the rule. It is 60 years. Now, it says in computing the payment on account, you can deduct the following things. 1, any current year capital losses that you know of prior to this disposal, the ACCA, and any losses brought forward at the beginning of the year. If not, you're going to have to do an estimate for that. And obviously the information will be given to you. And then what happens is, at the end of the tax year, you include the residential property with all your other gains and losses. You work out the tax based on your income tax position and which rate you're going to end up paying at, and then you work out the tax and then you deduct off it what you've already paid on account up front. So we have an illustration here that kind of explains that. So there's the illustration. So Lee is a high rate taxpayer, and during 23-24 he made the following disposals. So he made a gain of 22.5, a loss of 12,300, a gain of 67,500 on a residential property. And don't forget, residential properties are also taxed at a different rate, so you'd need to have different columns for that, and a loss on the disposal of some shares of 11. Okay, so the residential property was sold on the 31st of October, so a payment is required. Now, if you get one of these and you've got the date, state the obvious. It was sold on. Therefore, payment on account due, and give the date. Okay, give the date. Now, I've noticed on this that the date isn't quite right. That should actually be the 30th of December. Because the rules have changed. It was 30 days. It was 30 and now it's 60. Okay, so it would be the 30th of December that you'd have to make that payment. Just to reiterate, it is now 60 days and not the old rule, which is 30 days. So we have the residential property, and we were told in the rules that we could have the loss if it occurred before and the ACCA. That gives us a gain. Proceeds less cost equals gain. So obviously the gain's been done. Now we have the losses brought forward prior to the sale and the ACCA, and it's taxed at the highest rate. Now, at the end of the tax year, we have a residential gain. The losses, both losses are now brought forward, and the ACCA, and they're taken off the residential property because that's taxed at the highest rate. Obviously, that's going to be taxed at 28%. And then the other gain is in a separate column, as you can see there, because always separate them out if they have different rates of tax. And always clearly show, you'll get marked for putting that in the right place. And that gain there is going to be taxed at 20%, add the two together. Now you see we've added in the 10,696 and the 4,500 there. And we've taken off, that is the payment on account that we calculated earlier from up here, giving us now a balancing payment which is due on the 31st of January 2025. Okay, so that might come up. It could come up as a multiple choice question where you're asked about residential properties, or it might come up in a larger one like this where you've got to, that would be a full answer for probably part of section B or part of section C. So exam technique, so important, because capital gains tax will come up in the exam, simple as. It'll come up in partly in section A. Might get some multiple choice questions, but more likely in section B or section C. So it's even more important here to ensure you've read and understand the information provided in the question. Does the question give you a figure for gains, okay, which has been done for you, or does it ask you to work it out? Does the question give you taxable income of the taxpayer for the year, and therefore, or are you provided with the income figure and you have to deduct the personal allowance? There are lots of little traps within a capital gains tax computation. This is a very important chapter and a very important section. It will turn up. So make sure that you practice. Once you've read through the chapters and done in here, listen to the lecture and done your BPP manual. Practice. Only then will you start to recognise certain things that come up in all of the chapters. Okay. So does it ask you to work out the capital gains tax liability, or does it ask you to work out the gain? Now, there isn't a problem there, because if it asks you to work out the gain and you work out the gain and then you work out the tax, you're not going to get any marks for the tax. All you've done is waste your time. But that's not a problem in that sense. But just please read the question carefully. Does it ask you to compute taxable gains after AEA and losses, or simply the gains before AEA and losses? Obviously, don't rush your calculations. Show every working that you've got. It may be asked alongside inheritance tax, because what they're doing is preparing you for advanced tax, where these things always come up. You are advised, you may also be advised to, required to give advice about reliefs. That's in later chapters, we'll look at that later. So, a couple of multiple choice questions that you might be asked. Which of the following gifts is exempt for capital gains tax? Well, the boat, we have a boat, we have shares. Shares are never exempt. Okay, that's a chattel. Oops, spelt wrong. And that's a chattel, which means it must be that one. Now, you don't need to know that a boat is exempt. You've actually worked that out logically by the way you've dealt with these things. Okay, so use your common sense as well as your tax ability. And a couple more. Which of the two following statements about allowable capital losses for an individual are true? The AEA is deducted before any brought forward capital loss to utilise against current year gains. Now we're looking for two here, just make sure. Current year capital losses remaining after offset against gains can also be offset against current year income. Well, that's definitely not true. You can't move it backwards from gains into income. That's definitely not true. The AEA is deducted before current year capital losses to utilise against current year gains. Excess current year capital losses are carried forward indefinitely until a future gain arises. Okay, well that's not true either. Current year losses are not carried forward indefinitely. They are utilised. They are used in the current year. And again, by default, we found the two answers. So read the questions carefully and work out whether they are true or false, and you'll be able to kind of deal with these multiple choice questions a lot easier. And again, multiple choice questions, I find they're so much harder. You need to practice those multiple choice questions. So Joe acquired a holiday villa in May 2012 for 115,000. So that's his cost. He gave it to his wife. So that is a no gain, no loss transaction. When it was worth 100,000, she then sold it for 165,300. Never their main home. No other disposals, but she's got capital losses brought forward and she's high rate. What's her capital gains tax payable? Okay, so proceeds less cost equals gain. The proceeds is 165,300. Obviously, because this is multiple choice, it's either right or wrong. You'd have a box to put the answer in, so you can do this on a piece of scrap paper. The deemed cost is what he paid for it. Do you remember? When it comes to no gain, no loss transactions. We also have AEA, and we have losses brought forward, which means we're ending up with 40,000. She's a high rate taxpayer. It is a residential property at 28%, gives us £11,200. So you would then work that out and stick it in the box, unless you've got an A, B, C or D, and then you've got some answers that you can choose from.